Hello, everyone. Welcome back to the Daily Gold YouTube channel. Thank you so much for tuning in. This video is being recorded on the early evening of Monday, October 28th, 2024. Thank you so much for joining me. In this video, I'm going to talk about why secular inflation is worse than a stock market crash. When you think about it, secular inflation, it's really an invisible market crash that goes on for a decade or two. This video won't be too long, only have a couple charts. Let me get right to it. So this is a great chart showing the total real return of the 60-40 portfolio. So we're looking at bonds in the stock market plus dividends and then divided by inflation. So that's total real return, 60% in stocks, 40% in bonds. Now, interestingly, this portfolio, they rebalance it monthly. I think that really helps strengthen the data. It looks stronger based on, when I've done my own calculations. This rebalancing looks stronger. So that's something to keep in mind. So this shows the 60-40 portfolio going back over 100 years. And we can see, if you think about it, secular inflation is worse than crashes. There were two main crashes, in my opinion, in the stock market, or at least based on valuations just being off the charts. We had 1929 here and then 2000 here. So those were the two valuation peaks. And we can see these are not the worst secular bear markets here. Now, why is that? Because bonds, the 40%, were still in a bull market. They were still in a bull market here. They were still in a bull market here. And it's a point I made recently. When bonds are in a secular bull, that's when you get stock market crashes, because bonds are still going up. People can still make money in bonds. That allows them to dump stocks and go right into bonds. Now, when bonds are in a secular bear, like we're into now, and they went into in 1965, you don't get these big crash-like declines, although sometimes you do. And I'm thinking of the mid-70s, 73, 74. But anyway, back to the point about secular inflation being worse than crashes. So this is when you had the crash of the valuation crash. This is 1929. After this crash, bonds carried this higher. Same thing here. This in real terms, in real total return, this secular bear market did not last as long. Same with this one here. However, let's look at the inflationary periods right here and right here. Look at how much worse this secular bear was. Of course, you had the World War I. You were going sideways, and then way down here, towards the end of it. What an awful decline for that portfolio. So this, you had a secular commodity bull market from 1897 to 2020. I think 1906 to 1921. That was a secular bear in equities. So look at this. That's when you had inflation. And then, of course, we all know how bad this one was, which I'll get more into on the stock side. But, you look at where this was here. This is nearly a 20-year period. This wasn't just a lost decade. This was two lost decades here. Same thing with this period here. You could go from here, early 1900s, to what is that, 1923, 4? So, you had two lost decades here, two lost decades here. You didn't have that after the 2000 and 1929 peaks. Again, that's because bonds were in a secular bull. Now, bonds have fallen into a secular bear. Next will be the stock market falling into a secular bear. Let's get to my chart. So, this is just total real return for the stock market, so it excludes bonds. Also have gold here. We have CPI inflation. This is monthly data. This is the 20-year rolling return for the stock market. So, all the time we hear, just buy stocks for the long, just buy and hold, just keep buying, just buy, don't sell, just keep buying. And most of the time, that's probably good advice because the market does go up over time, even in real terms, as you can see from this chart. However, if you are getting into a new secular cycle of inflation, like you were here, here, and then what we could be going into, that's That's very bad for the 60-40 and also the stock market as well. And I've talked a lot about this period, but these lines show, look, this is the peak in 1962 to 1982. This is actually 21 years. So this peak, 21 years later, even with dividends, zero return 21 years later. Here, you had this peak around, let's say 66. This is 84, 85. So this is about 19 years. So, and again, this is just looking at the stock market, not including bonds. So this here, this is about 13 years. 30. Now this one was about 20 years, but that's because we had the big crash here. But you give it a couple more years, this thing really broke away. That's basically the point, people, is if we get into a secular inflationary cycle, which I think everyone thinks we're probably in, that's going to be negative for the stock market over a long period of time. Stocks are not a hedge for inflation when you're in a secular inflationary cycle. Now, disinflation, on the other hand, when inflation peaked here and here, and also 2011 to a lesser degree, you have these peaks here. That's when you get the big moves in stocks. It's the opposite. It's when inflation is coming down. The secular cycle of inflation has turned lower. That's disinflationary. So even if you 2, 3, 5%, you get that. But if the secular trend is down, that's when stocks do really well and will outperform inflation significantly over time. But when the secular inflationary cycle is turning up, like it probably is right now, or has or will, that's negative for stocks over the next 10 or 20 years. So I think we are, to draw a historical comparison, we could be somewhere here. Are we in 1964, 1965? I mean, look, even at this point, stocks were still, they didn't start to, at the beginning of the inflation, rather, stocks can still go up. It's once you kind of get to that middle point, that's when it gets dangerous and stocks really get hit hard. This bear market here, this one here, 37 to 40, that was a really bad one in the middle of this inflation. This one here, that was in the middle of the inflation. I think we could get that kind of bear market. Maybe not in the next year, but who knows? Maybe 2 or 3 years if we still have that much of a move left, if the economy is able to hold up for a couple more years. Okay, that's the video. Last thing, check out the Daily Gold Premium. Would love to have you subscribe. It's just the beginning, people. New secular bull market in precious metals. This is going to carry on for at least a decade. Very optimistic. Always looking for value. Trying to help everyone make money. So consider thedailygold.com/premium. You can go there to subscribe to the service. Thank you so much for tuning in. Let me know what you think. Leave a comment. And I'll talk to you guys again in the next video. Thank you.